Silver reaches $121 ATH, copper $6.50. Boom, is this the supercycle? Silver just crossed $121 per ounce. Copper shattered $6.50. Both metals breaking records not seen in decades. But here's what the headlines aren't telling you. China quietly stopped exporting refined silver. 678 million ounces have vanished from global supply, and the paper market is leveraged 350 to 1. While industrial demand is about to double by 2030, the question isn't whether this continues. The question is what happens when the remaining 350 paper claims try to collect on 1 single ounce of physical metal. And the answer to that question could redefine wealth preservation for the next generation. Welcome to Silver Collapse Coming. If you've been following global markets with the wisdom that comes from experience, you know that real wealth isn't built on speculation. It's built on understanding what others miss. We'd be honored if you'd subscribe to this channel. Think of it as reserving your seat at a briefing table, where serious economic analysis replaces market noise. And before we continue, we're curious, from which corner of the world are you watching this unfold? Drop your location in the comments. Let's see how global this community truly is. Now, let's examine what's actually happening beneath these price movements. On a single trading day in early 2025, something unusual happened in the metals markets. Silver crossed $121 per ounce for the first time in recorded history. At the exact same moment, copper surged past $6.50 per pound on COMEX. These weren't small movements. Silver had climbed 450% in just 24 months. Copper jumped more than 7% in a single session, the sharpest one-day move in 16 years. For traders watching their screens that morning, the question was simple. Was this panic buying, or was something fundamental breaking in the global commodity system? The numbers told a story that most analysts weren't prepared to accept. Silver had added over $6 trillion to its total market capitalization. It became the best performing asset class in the world. Not technology stocks, not cryptocurrencies, physical silver. Copper's move was equally dramatic. Prices in London hit $14,000 per ton. COMEX futures contracts exploded higher on volume that hadn't been seen since the 2008 financial crisis. Industrial buyers who needed these metals for manufacturing were suddenly paying prices they had never budgeted for. The immediate explanation from financial media was straightforward. China had announced new stimulus measures. Hopes for infrastructure spending and housing construction drove commodity buyers into the market. The US dollar had weakened, making dollar-denominated metals more attractive to international buyers. These factors were real, but they didn't explain the magnitude of the moves. A 7% single-day surge in copper doesn't happen because of stimulus hopes alone. A 450% rally in silver over 2 years doesn't happen because the dollar weakened. Something deeper was occurring beneath the surface of these markets. Glencore, one of the world's largest copper producers, had just cut its 2026 production forecast. Mine problems in Chile were reducing output, but Chile accounts for roughly 25% of global copper supply. When a quarter of the world's production faces constraints, and demand from electric vehicles, data centers, and renewable energy keeps accelerating, the mathematics become unavoidable, supply tightens, prices rise, and once prices start rising fast enough, momentum feeds on itself. For silver, the dynamics were even more complex. The metal serves 2 completely different functions. It's a store of value, like gold, but it's also an industrial metal, like copper, and that dual nature was creating pressure from both sides. On one side, investors were buying silver as protection against currency debasement. Central banks around the world had printed trillions in new money since 2020. Inflation had eroded purchasing power. Trust in fiat currencies was declining. Precious metals were the traditional escape. On the other side, industrial users desperately needed silver for production. Solar panel manufacturers couldn't build panels without it. Electronics companies couldn't produce high-performance components without it. Defense contractors needed it for military applications, the automotive industry needed it for electric vehicle systems, and artificial intelligence data centers required it for power infrastructure. This wasn't theoretical demand, it was concrete, measurable, and growing. The Solar Energy Industries Association projected that solar silver demand alone would more than double by 2030, from roughly 200 million ounces per year to 450 million ounces annually. That single sector would consume nearly half of total global silver mine production. Meanwhile, mine production wasn't increasing. In fact, it was stagnating. Major silver-producing regions were reporting declining ore grades, meaning miners had to process more rock to extract the same amount of metal. Exploration budgets had been cut during the low-price years. New discoveries weren't replacing depleting reserves. The pipeline of future supply was shrinking just as demand was exploding. But here's where the situation became truly unusual. Most silver trading doesn't involve physical metal at all. It happens through paper contracts, futures, options, and exchange-traded instruments. Traders estimate the ratio of paper claims to physical metal at roughly 350 to 1. That means for every actual ounce of silver in a vault somewhere, there are 350 paper contracts claiming ownership of an ounce. The system works perfectly well. As long as nobody asks for physical delivery, as long as everyone accepts paper promises as equivalent to real metal. But in early 2025, something started changing. Physical delivery requests were increasing. Premiums for immediate metal started widening. In Shanghai, silver was trading at $138 per ounce, while Western markets showed $120. That $17 difference represented something critical. Physical silver inside China was becoming scarce. And when physical metal becomes scarce in one major market, the pressure eventually spreads everywhere else. The traders celebrating the Supercycle that morning were seeing the price movements, but most of them weren't seeing the structural fractures forming underneath. Fractures that would determine whether this was just another commodity rally or the beginning of a complete repricing of strategic industrial metals. The evidence was starting to pile up, and it pointed toward something far larger than a temporary spike. It pointed toward a supply crisis that had been building for years, unnoticed, until the day the prices finally broke. While markets celebrated record prices, a quiet crisis had been unfolding for half a decade, one that most investors never noticed because it was happening underground, in refineries, and inside Chinese government ministries. The world had been consuming more silver than it produced, not for 1 year, not for 2 years, for 5 consecutive years. The cumulative deficit reached 678 million ounces. To understand what that number means, consider this. Global mines produce roughly 800 million ounces of silver annually. The deficit represented nearly an entire year of worldwide production. Simply gone, vanished from available supply, used up in solar panels that would never be recycled, embedded in electronics sitting in landfills, consumed in industrial processes that destroyed the metal permanently. The mining industry wasn't blind to this problem, but solving it required years of investment and exploration. Finding a new silver deposit takes 5 to 7 years on average. Developing it into a producing mine takes another 3 to 5 years. By the time companies realized they needed more supply, the deficit was already baked into the system for the next decade. Ore grades were declining across major producing regions. In Mexico, which produces roughly 23% of the world's silver, miners were processing lower quality rock every year. In Peru, the second largest producer, the same pattern emerged. More energy, more labor, more capital, all required to extract the same amount of metal. This wasn't a temporary technical problem. It was geological reality. The easy, high-grade deposits had been mined decades ago. What remained was harder to extract and more expensive to process. But in August 2024, the supply situation took a dramatic turn. China implemented new export licensing requirements for refined silver, not silver ore, refined, processed silver ready for industrial use. The announcement was bureaucratic and technical. Few Western analysts paid attention, but the implications were staggering. China doesn't just mine silver. China controls a substantial portion of global refining capacity. When Chinese officials decided to restrict exports, they weren't just limiting Chinese mined silver. They were creating a choke point in the global supply chain. Within months, the effects became visible. Silver prices in Shanghai began trading at significant premiums to London and New York. By early 2025, that premium reached $17 per ounce. Physical metal inside China was worth 14% more than identical metal outside China. That price gap revealed something crucial. Arbitrage should have closed that differential immediately. Traders should have shipped silver to Shanghai and sold it for the higher price, but they couldn't. Because China's export controls worked in both directions, getting refined silver into China was possible. Well, getting it back out was nearly impossible, and the metal went in and stayed there. Industrial manufacturers outside China suddenly faced a choice: pay higher prices for increasingly scarce metal, or delay production and risk losing contracts. For solar panel manufacturers, the problem was existential. Each solar panel requires a small amount of silver, but global solar installation targets required hundreds of millions of panels. The math was brutal. Solar silver demand was projected to grow from 200 million ounces in 2024 to 450 million ounces by 2030, a 125% increase in 6 years. That alone would consume more than half of total annual mine production. And solar was just one demand sector. Electric vehicle production was scaling globally. Each EV required silver for battery management systems, charging infrastructure, and power electronics. The automotive industry's transition from internal combustion to electric wasn't optional anymore. Governments worldwide had mandated it through regulations. Manufacturers had committed billions to retooling factories. They couldn't stop buying silver even if prices doubled. Artificial intelligence was creating entirely new demand. Data centers powering AI systems required massive electrical infrastructure. Silver's unmatched conductivity made it irreplaceable in high-performance applications. Microsoft, Google, Amazon, and Meta were building data centers at unprecedented scale. Each facility required tons of silver and electrical components. Defense contractors added another layer of inelastic demand. Military applications demanded the highest reliability. Silver's properties made it essential for radar systems, missile guidance, and communications equipment. National security considerations meant defense buyers paid whatever price was necessary. Then came the refining bottleneck. In late 2025, approximately 9.7% of global silver refining capacity went offline. Aging facilities in Europe faced environmental compliance issues. Maintenance problems shut down operations in South America. Even when silver ore existed, it couldn't be processed fast enough into usable form. The metal sat in concentrate form, unusable for manufacturing, creating artificial scarcity on top of real deficits. Exchange-traded funds made everything worse. In early 2025 alone, silver ETFs absorbed 95 million ounces. Investors buying these funds thought they were gaining silver exposure. What they were actually doing was removing physical metal from industrial circulation. Those bars went into vaults, locked away, no longer available for solar panels or circuit boards or medical devices. Then in August 2025, the United States government made a quiet but significant move. Silver was added to the official critical minerals list. The classification change seemed administrative, but it represented a fundamental shift in how governments viewed the metal. Silver wasn't just a commodity anymore. It was a strategic resource, essential for national security and economic competitiveness, the same category as lithium, cobalt, and rare earth elements. While all this was happening, China was making another strategic move. The People's Bank of China accumulated gold reserves to a record 74.1 million ounces. At the same time, Chinese holdings of U.S. Treasury securities fell to an 18-year low. The pattern was clear. China was reducing dollar exposure, increasing hard asset positions, and controlling strategic industrial metal supply chains. These weren't separate policies. They were coordinated elements of a long-term strategy. The question facing Western governments and industrial buyers was no longer academic. It was immediate and practical. How do you build solar infrastructure, electric vehicles, and defense systems when a geopolitical competitor controls the refined supply of an irreplaceable input material? The answer to that question would determine far more than silver prices. It would reshape global industrial policy for the next decade. But first, the financial markets had to reckon with another problem. The paper market structure that had kept silver prices suppressed for years was beginning to crack. There are two silver markets operating simultaneously. Most people don't realize this. One market deals in physical metal, bars sitting in vaults, coins held in safes, real silver you can touch, weigh, and store. The other market deals in promises, contracts, derivatives, paper claims on silver that may or may not actually exist. And the second market is roughly 350 times larger than the first. For decades, this arrangement worked without major problems. Banks and traders bought and sold silver contracts on COMEX and the London Bullion Market Association. Prices moved up and down based on these paper trades. Physical metal rarely changed hands. Sellers simply paid buyers the price difference when contracts expired. Everyone accepted paper pricing as legitimate. Now, the system was efficient, liquid, and profitable for intermediaries. But efficiency has a hidden cost, and that cost only becomes visible when someone actually asks for the metal. In traditional commodity markets, paper contracts exist because physical delivery is expensive and inconvenient. Most wheat traders don't want truckloads of grain delivered to their office. Most oil traders don't want tankers showing up at their door. So paper settlement makes sense. But silver is different. It's valuable enough to store compactly, stable enough to hold indefinitely, and increasingly critical enough that industrial users need guaranteed supply. When physical demand rises faster than mine production, when geopolitical tensions disrupt supply chains, when governments classify materials as strategically critical, the paper market's fundamental assumption breaks down. That assumption is simple. Most contracts will settle in cash, not metal. But what happens when that assumption reverses? In February 2025, silver lease rates spiked to nearly 39% annualized. Lease rates measure the cost to borrow physical silver. Under normal conditions, they hover near zero, maybe 1% or 2% at most, because silver sits in vaults not doing anything. Owners are happy to lend it out for small fees, but 39% annual rates revealed something extraordinary. Physical silver had become extremely difficult to borrow. Vault holders weren't willing to lend it, even at historically high rates. Why? because they weren't confident they'd get it back. When a bank or a trader lends physical metal, they expect to receive the same metal returned later. But if that metal is needed immediately for industrial production, if delivery demands are overwhelming available supply, if refineries can't process new metal fast enough, then returning borrowed silver becomes impossible. The lender keeps the collateral instead, and suddenly, lending metal at any rate becomes too risky. Backwardation appeared simultaneously. In normal commodity markets, futures contracts trade at higher prices than spot prices. This makes sense. Future delivery includes storage costs, insurance, and time value of money. But when spot prices exceed future prices, the market is in backwardation. It means buyers want metal now, not next month, not next year. Now, they're willing to pay premium prices for immediate delivery. Silver backwardation had appeared before, during the Hunt Brothers episode in 1980. During the 2020 delivery squeeze when COVID disrupted refineries, each time it signaled severe physical shortage. And in 2025, backwardation reached levels not seen in decades. The paper market structure made this situation particularly dangerous. Estimated leverage of 350 to 1 meant massive vulnerability. Here's how it worked. A mining company produces 1,000 ounces of silver. They sell it to a refiner. The refiner sells it to a bank. The bank creates 350,000 ounces of paper claims against that physical metal. Hedge funds, ETFs, and speculators buy and sell these paper claims. As long as only a tiny percentage ever demand actual delivery, the system functions. But if even 5% of paper holders demand physical settlement, the bank needs 17 out of 500 ounces and only has 1,000. The mathematics become catastrophic. They must buy physical silver in the spot market, but physical supply is already tight. So buying drives prices higher, which triggers stop losses on other short positions, forcing more buying, which pushes prices even higher, creating a self-reinforcing loop that only ends when shorts are completely liquidated, or when regulators intervene to freeze the market. This dynamic isn't theoretical. It happened in nickel in 2022. When a Chinese company faced a massive short squeeze, the London Metal Exchange simply canceled trades and shut down the market. Billions of dollars in positions were unwound at artificial prices. The integrity of the market was sacrificed to prevent systemic failure. Silver faced the same risk, but on a much larger scale, because silver's industrial importance meant production couldn't simply stop. Manufacturers needed continuous supply. Regulators couldn't freeze the market without freezing global manufacturing. The Shanghai Premium illustrated this perfectly. At $17 above Western prices, arbitrage should have been immediate and obvious. Buy silver in London at $121. Sell it in Shanghai at $138, pocket $17 per ounce profit. But that trade was impossible because China's export controls meant metal couldn't flow freely. The premium persisted, proving that physical markets and paper markets were decoupling. Price discovery was fragmenting geographically. Two different prices for the same commodity in different locations. That fragmentation suggested the global pricing mechanism was breaking down. Copper showed parallel stress patterns. Glencore's production cuts in Chile weren't isolated incidents. Water scarcity was affecting multiple mining operations. Environmental regulations were tightening across South America. Political instability in Peru threatened major copper districts. Meanwhile, copper demand was compounding faster than silver. Electric vehicles require 3 to 4 times more copper than conventional cars. Each EV needs roughly 180 pounds of copper in wiring, motors, and batteries. Global EV production was targeting 30 million vehicles annually by 2030. That alone required 2.4 million tons of new copper supply. AI data centers added another massive demand layer. A single large-scale data center requires thousands of tons of copper. For power distribution, cooling systems, and server infrastructure, Microsoft, Amazon, and Google were building dozens of these facilities simultaneously. The renewable energy transition multiplied copper intensity across the entire grid. Wind turbines, solar farms, and battery storage all required substantially more copper than traditional power generation. When analysts calculated total copper demand against available supply, the deficit projections were staggering. Some estimates showed cumulative shortfalls exceeding 10 million tons by 2030. That represented more than 3 years of current global production, simply missing from the supply chain. And unlike silver, copper had no meaningful above-ground stocks, no strategic reserves, no government stockpiles. When supply tightened, there was no buffer. Prices would simply rise until demand was destroyed. But how do you destroy demand for copper when entire economies are mandating electrification? The answer was uncomfortable. You don't. You pay higher prices and pass those costs downstream to consumers. As inflation, the convergence was becoming clear. Silver's paper leverage problem, copper's physical supply deficit, China's strategic commodity positioning, refining bottlenecks, accelerating industrial demand, geopolitical fragmentation. These weren't separate issues. They were interconnected elements of a single structural transformation. The global commodity pricing system that had functioned for 50 years, built on paper derivatives and fungible supply chains, was encountering conditions it wasn't designed to handle. And when systems encounter conditions beyond their design parameters, they don't adapt gradually, they break suddenly. The only question was timing. How long could the paper markets maintain artificial pricing before physical reality forced a violent reconciliation? And what would that reconciliation look like? When 350 paper claims tried to collect on a single physical ounce, the answer was forming in real time, in vault withdrawal data, in widening premiums, in backwardation, in lease rates, all pointing toward the same conclusion. The paper illusion was ending. Physical scarcity was becoming the new pricing mechanism, and the repricing had only just begun. In March 2025, two data points appeared in separate financial reports. Most analysts saw them as unrelated. They weren't. China's official gold reserves reached 74.1 million ounces, a record accumulation. At precisely the same time, Chinese holdings of U.S. Treasury securities fell to 686.6 billion, an 18-year low. These weren't random portfolio adjustments. They were coordinated elements of a strategic repositioning, away from dollar-denominated financial assets, toward physical commodities and hard assets. When combined with China's silver export restrictions, a clear pattern emerged. China was building leverage in physical markets, while reducing exposure to Western financial markets. The implications went far beyond metals trading. For decades, global commodity pricing operated on a simple assumption. Markets were fungible. Supply could flow freely across borders. Financial markets and physical markets remained synchronized through arbitrage, but that system required political stability and open trade. When geopolitical competition intensifies, when nations view commodities as strategic weapons rather than tradable goods, the entire structure changes. China's approach revealed sophisticated understanding of this dynamic. Control refined silver supply, accumulate gold reserves, reduce treasury holdings, restrict rare earth exports. Each action appeared modest in isolation, but together they created something powerful. Commodity leverage in a fragmenting world. Western governments faced an uncomfortable realization. Their green energy transition required materials they didn't control. Solar panels needed silver. Electric vehicles needed lithium, cobalt, and rare earths. Battery production needed graphite and manganese. Wind turbines needed neodymium. China controlled substantial portions of the supply chains for all of these. Not through military force, through refining capacity, processing expertise, and strategic resource development over 20 years. While Western nations financialized their economies, China built physical infrastructure. The consequences were now becoming measurable. A European solar manufacturer couldn't source enough silver. Production delays cascaded through the supply chain. An American EV company couldn't secure battery materials at reasonable prices. Vehicle launch dates slipped. A defense contractor couldn't obtain rare earths for guidance systems. Military procurement timelines extended. These weren't hypothetical scenarios. They were reported incidents from early 2025, and they revealed a fundamental vulnerability. You cannot build industrial capacity without industrial materials, and you cannot access industrial materials if another nation controls the supply. The United States government's response came in stages. First, adding silver to the critical minerals list in August 2025, then proposing domestic refining capacity expansion, then negotiating supply agreements with allied nations. But building refining capacity takes years. Developing new mines takes even longer. The strategic gap couldn't be closed quickly. Meanwhile, the monetary system showed its own stress fractures. President Trump's statement that the United States should pay the lowest interest rates of any country carried enormous implications. Lower rates with rising debt meant one thing: currency debasement. When a nation owes $36 trillion and interest costs exceed $1 trillion annually, and political will to cut spending doesn't exist, the Federal Reserve faces limited options: keep rates high and risk economic collapse, or lower rates and accept inflation. The bond market was already telegraphing expectations. Long-term Treasury yields remained elevated despite Fed rate cuts. Investors demanded higher returns to compensate for inflation risk. The yield curve inversion that had predicted every recession for 50 years was normalizing, but not because economic conditions improved. Because inflation expectations were rising, precious metals responded predictably. Gold hit new all-time highs above $2,800 per ounce. Silver's 450% rally reflected similar dynamics, but silver carried additional industrial demand that gold didn't, making its supply-demand imbalance more severe. Analysts debating whether this was a supercycle were asking the wrong question. The term supercycle implies a temporary, albeit extended, price movement. What was happening went deeper. This was structural repricing. The difference matters. A cycle eventually reverses. Structural repricing reflects permanent changes in supply-demand fundamentals. Consider the evidence. Mine supply couldn't increase fast enough to meet demand. China's strategic positioning wasn't temporary policy. Industrial electrification was mandated by governments worldwide. AI data center build-out was accelerating, not slowing. Defense spending was rising across all major powers. Solar deployment targets required doubling silver consumption in 6 years. None of these factors would reverse. Even if prices doubled again, mine production wouldn't surge immediately. Lead times were too long, capital requirements too large, geological constraints too binding. The solar industry alone provided stark mathematics. Current annual mine production, approximately 800 million ounces. Projected solar demand by 2030, 450 million ounces. That left only 350 million ounces for all other industrial uses, jewelry, investment, and coinage. But industrial demand from EVs, electronics, AI, and defense was also growing. The numbers simply didn't reconcile, unless prices rose high enough to destroy discretionary demand, or unless technological substitution occurred at massive scale. But silver's unique properties made substitution difficult. Highest electrical conductivity of any metal, highest thermal conductivity, superior reflectivity, excellent antimicrobial properties. In critical applications, alternatives performed worse or cost more. Engineers don't substitute inferior materials in systems where failure is unacceptable. This created demand inelasticity, meaning price increases didn't significantly reduce consumption. Markets could only clear through higher prices, much higher prices. But how high? Historical precedents offered limited guidance. The 1980 silver peak of $50, equivalent to roughly $185 in 2025 dollars, occurred under different conditions. That was a speculative bubble driven primarily by the Hunt brothers' attempted corner. Current dynamics involved actual physical deficits and industrial demand growth, not speculation. Fundamental scarcity. Some analysts projected silver could reach $200 or higher if supply stress continued. Others dismissed such forecasts as hype. The truth was unknowable, because markets in structural transition don't follow predictable paths. They're volatile, unpredictable, and subject to sudden regime changes. What was predictable were the risk factors. On the bearish side, China's economy remained uncertain. Property sector troubles persisted. If Chinese industrial activity contracted significantly, commodity demand could weaken. Copper's rally partially depended on stimulus expectations. If those expectations disappointed, prices could retrace sharply. For silver, regulatory intervention remained possible. If the paper market squeeze became too disorderly, if systemic financial institutions faced failure, regulators could impose position limits, force liquidations, or even suspend trading temporarily. This had precedent. The Hunt brothers in 1980, the nickel market in 2022. When markets threatened systemic stability, authorities intervene. Additionally, if inflation moderated and real interest rates rose substantially, precious metals could face selling pressure. Higher real yields make holding non-yielding assets less attractive, and no analysis could ignore volatility risk. 450% moves create their own dangers. Corrections are inevitable. Traders who over-leveraged or chased momentum without understanding fundamentals would face severe losses. That pattern repeated throughout financial history, but the bullish case carried equal weight. Every bearish factor assumed the current system could continue. That assumption was increasingly questionable. China's strategic commodity positioning wasn't reversible through policy tweaks. It represented decades of infrastructure investment. The 678 million ounce silver deficit accumulated over 5 years wasn't going away. Mine production was stagnant. Industrial demand was accelerating from multiple sectors simultaneously. The paper-to-physical leverage ratio of 350 to 1 remained unsustainable under physical delivery pressure. Lease rates at 39% and persistent backwardation indicated structural shortage, not temporary tightness. Refining capacity constraints couldn't be solved quickly. ETF absorption of 95 million ounces removed metal from circulation for extended periods. U.S. critical minerals classification signaled government recognition of strategic vulnerability, and the monetary backdrop continued deteriorating. Federal Reserve Chair Powell had acknowledged the unsustainable trajectory of U.S. debt. Political incentives pointed toward inflation rather than austerity. Currency debasement would accelerate, not reverse. The convergence of these factors created conditions unlike anything in modern commodity market history: simultaneous supply deficits, geopolitical weaponization of resources, monetary system stress, industrial transformation requiring massive material inputs, paper market leverage reaching breaking points. When systems encounter multiple simultaneous stresses, they don't adjust gradually. They break suddenly, often in ways that seem obvious in retrospect, but are invisible beforehand. For holders of physical silver and copper, the strategic implications were clear. Physical possession bypassed paper market risk, eliminated counterparty risk, avoided jurisdictional uncertainty, provided direct exposure to supply-demand fundamentals. But physical holdings required patience. Volatility would be extreme. Corrections would be sharp and unpredictable. Emotional discipline would separate successful holders from those who sold at bottoms. For traders, momentum could persist far longer than seemed rational, especially when fundamentals supported price moves, but leverage magnified losses as well as gains. Position sizing and risk management weren't optional. They were survival requirements. For those on the sidelines, waiting for pullbacks made intellectual sense. But structural breakouts often don't provide comfortable entry points. The 1970s gold and silver bull markets saw corrections, but the overall trend persisted for a decade. Those who waited for the perfect entry often never got positioned. 3 conclusions emerged from the evidence. First, physical markets were decoupling from paper pricing mechanisms. Shanghai premiums, lease rate spikes, and backwardation confirmed this wasn't temporary. Second, China's strategic positioning represented fundamental realignment in the global commodity and monetary order. Gold accumulation, silver export controls, and treasury reduction weren't separate policies. They were coordinated strategy. Third, industrial demand from solar, EVs, AI, and defense was compounding at the exact moment supply chains were fragmenting. That combination created conditions for sustained price escalation, but 2 critical questions remained unresolved. First, how violently would paper markets adjust when physical delivery pressure became unsustainable? Would regulators allow market forces to operate, or would they intervene to protect systemic institutions at the expense of price discovery? Second, how would Western governments respond when China's commodity leverage became undeniable? Would they accept dependency on a geopolitical competitor for critical materials, or would they restructure supply chains regardless of cost? Those answers would determine the next phase, not just for silver and copper prices, but for the broader structure of global trade and monetary systems. The evidence suggested a generational repricing was underway. Not a trade, not a cycle. A structural transformation of how strategic industrial metals were valued. In a world fragmenting along geopolitical lines, where monetary systems faced unsustainable debt, where industrial transformation required materials in chronic deficit, physical assets controlled by sovereign nations gained power. Financial assets denominated in depreciating currencies lost credibility. That shift had only begun. The full implications would unfold over years, with volatility, reversals, and uncertainty throughout. But the direction was becoming clear. Markets were repricing scarcity in real time, with consequences that would reshape investment strategy, industrial policy, and geopolitical power for the remainder of this decade and likely beyond.